Hello and welcome to this webinar on wealth creation strategies for doctors and dentists. My name is Yves Schoof and I specialize in providing strategic financial advice to doctors and dentists. Now, many of our clients are young dentists or doctors with young families, obviously, and many of our clients are actually seeking the same thing. They really want to do more with their money and their cash flow, and many of them have the goal to be financially independent around their age 50. What that means for many of those people is that they want to be free of any home mortgage, and they can see themselves still working, but obviously part-time, and they want to be able to make lifestyle decisions and choices around that time. Now, our clients understand that this can be achieved if you start early enough and if you apply, obviously, the right strategies. So that's what we'll be talking about today. Now, before I get started, obviously, I just need to run through this disclaimer pretty quickly. I'll be talking about various strategies and investment products. None of those are obviously tailored to your particular situation. So you need to make sure that you get independent tax and financial advice before you make any decisions. Okay, so for me, wealth creation is really about three things going hand in hand. And first of all, that would be the attitude that you have. So you need to have the right mindset. So in essence, that really means that you need to be able to think long term and be disciplined when it comes to managing your money and your investments. Secondly, you need to manage your cash flow extremely well and put in place deliberate strategies that will allow you to create wealth over time. And thirdly, then obviously, you need to apply the right strategies and also investments to make sure that you maximize all your opportunities when it comes to wealth creation. So we'll go through these in a bit more detail now. And let's start with attitude, so the first element of that formula. So for me, there are 6 key predictors of wealth, and I actually took these elements from The Millionaire Next Door, which is an extremely useful book to read. It's sort of an all-time finance classic. So if you're interested in reading it, the title is The Millionaire Next Door. Now, in that book, they talk about why some people become millionaires or financially successful and why some people don't. And these are some of the key elements, I guess, that refer back to that. So let's start with number 1, planning and monitoring. So basically, can you set goals and effectively monitor your progress towards achieving those goals? Now, in my experience, not many people actually set personal financial goals and let alone that they track them. So that's obviously point number 1. Second point, focus. So do you really have the discipline to avoid distractions and stay on track to achieve your goals? And so I personally believe this has a lot to do with your goal setting. So are your goals so important that you maintain that discipline? Or have you perhaps set wishy-washy goals that you're not fully sort of in tune with? And then obviously you're not going to do everything within your power to achieve those. Number 3 is pretty self-explanatory. So that's obviously you need to spend less than what you earn, and unfortunately, we see a lot of people that spend a lot more than what they earn. So obviously, if you want to have surplus cash flow, you need to control your spending. Number 4 is an interesting one. So to what extent do you believe that you have control over your financial affairs and your outcomes, as opposed to perhaps having the belief that everything is basically externally determined? And what I mean by that is that a lot of people focus on the external environment in terms of what interest rates are doing, what the share market is doing, how superannuation legislation is changing. And let's face it, you cannot control the external environment, but you do have control over your own financial position and how you can optimize that within that wider framework. Yet what we see is a lot of people just focus on the things that they cannot control and get extremely stressed and just lose sight of the things that they can actually implement themselves. So that's a really interesting one. Number 5, confidence. So do you have the confidence to believe that you're capable of improving your financial situation. Perhaps you might currently be overwhelmed or stressed by your financial position. Perhaps you lack the time to manage your money. If that's the case, well then maybe you need to think about outsourcing your finances. And that's probably the number one intangible benefit that our clients report, just having that peace of mind, feeling confident and in control again over their financial position. Number 6 is really obvious again, and obviously there's a lot of peer pressure that comes into this as well for doctors and dentists. But in essence, do you feel a need to spend to display your social status, or are you socially indifferent to the spending habits of your peers, for example? Now, combined, these 6 wealth factors help to reveal who is more likely to actually convert their income into wealth. And if we had to summarize that in really simple terms, what I would say is you really need to have a plan that outlines very specific goals, includes deliberate strategies that will allow you to save and invest, that will allow you to take control over your own destiny rather than relying on what's happening in the external world. And the other thing is obviously to regularly review the plan and monitor your progress. So that's the first component of the formula that we looked at. So let's have a look now at the other 2 components, being cash flow and then obviously also strategies and investments that are suitable for medical professionals. So when it comes to cash flow, whether you earn $100,000, $200,000 or more than $500,000, it doesn't really matter. If you don't have a strict cash flow management structure in place, you will basically spend everything that you earn and possibly more. Because we all know that people in the street probably think that all doctors and dentists are millionaires, but I know, and you would know, that typically that's not true. And why is that? Well, look, basically earning $200,000 or $300,000 before tax isn't really all that much once you factor in, like we said, income tax, mortgage repayments, school fees, living expenses. But despite all of this, you should still be able to find a way to make financial progress by using your cash flow better. And so how could you typically achieve this? Well, the way we do it with our clients is firstly setting goals, like we said before, and working out for yourself and your family what is most important to you. Then once you've identified those goals, you need to fund them. And the way to fund them is to basically direct your cash flow to those goals via automated payments. And this could be as simple as increasing your mortgage repayments. It could be setting up regular super contributions, or it could be setting up a savings plan into an investment portfolio or an education fund, for example. The key with that is that you're actively paying yourself first, so you're funding everything that's really important to you, and then you're basically spending what is left over. And I can assure you, based on me working with people like yourself and many doctors and dentists, I can assure you that there should still be plenty of money left. So hopefully you can see that this is actually the reverse of what you might be doing currently, where people just spend money and then save whatever is left at the end of the day. But typically what happens is there's really not that much left. And so you basically keep living from paycheck to paycheck. Now, this is an extremely important part of our financial planning process, and it's typically something that most financial planners or people wouldn't even look at. So for us, it all starts with your cash flow. Now, let's have a look at some different strategies and investment options for medical professionals. Now, property is obviously an all-time favorite for many doctors and dentists. It's not hard to see why, because obviously it's very easy to get credit, and it's also, or it can be very tax efficient, because you obviously get a lot of tax deductions for investing in property. But despite what some accountants and advisors are saying out there, I wouldn't consider your own home to be an investment, because speaking practically, I very rarely see people downsize and make money in the process. More often than not, I've actually seen people lose money on their own home because it's an emotional and not a rational investment. And so when it comes to your own home, I have a few golden rules that I'd like to share with you. The first one is don't overcapitalize. So make sure you don't have the most expensive house in the street or in the suburb, because obviously that makes it quite volatile in terms of its price, and it doesn't really have any benchmark. So you might have spent too much on that house, and when you sell it, it will obviously be compared to the average house within that suburb or within your street, and you may not achieve the price that you actually paid for it. Secondly, understand the opportunity cost of having a large mortgage. So I've seen people with mortgages over $2 million, and obviously they're paying about $100,000 just in interest alone. So imagine if you could invest that amount of money on an annual basis, $100,000 going into your bank account in your investments rather than into the bank's pocket. So make sure that you don't spend too much on a house, and make sure that you can pay off your mortgage in 10 years or less, or as close to that time frame as possible. Any longer than that, and the interest really starts to balloon and obviously starts to become a tremendous opportunity cost. Negative gearing, like I said, is probably one of the primary reasons why medical professionals buy property. But bear in mind that you're still losing money. Negative gearing means that you're making an income loss, and your costs for maintaining that property are higher than the income that you're getting. So really you need a long-term plan to make money from that property, whether that's where it becomes positively geared, or you pay down the loan, or you perhaps sell it at a gain. But just be really mindful of that, because obviously what we're seeing here locally in WA, in Perth, is that a lot of house prices have actually dropped. And typically what happens is medical professionals only put down a 10% deposit. And so we're seeing a lot of our clients with negative equity in their property, which basically means that the value of the property is worth less than a mortgage. So if you were to sell that property, you'd still have a mortgage left. So I've got some clients, for example, that have bought properties in the last 8 years and then another one in the last 3 years. And this client is carrying a $120,000 loss on those properties. So don't be fooled into thinking that property only ever goes up, because I've seen plenty of clients lose huge amounts of money on investment properties. Make sure that you get professional advice when you buy property. If you're going to spend anywhere from $500,000 to $1 million on one property, I think it's well worth it to seek professional and independent property advice. The other thing I would say is diversify. So if you do invest in property, make sure that you balance that with other investments. Because what I've basically found is that you cannot retire on residential property. If you're lucky, you will get a 1 to 2% net rental yield, which basically means that the net income that you have after paying all the expenses. And that's obviously very little, because you might even be getting more in your bank account or in the term deposit. And so the reality is that if, as a doctor or a dentist, you want to have a reasonable lifestyle in retirement, you'd need to have a residential investment property of perhaps up to $10 million, which is just not realistic. And it's not very practical either, because in retirement you wouldn't want to be dealing with perhaps 20 sets of tenants or property managers. So I know this is being heavily promoted by some medical accountants and financial advisors, but honestly I don't believe in this. Quite often I think it's just a way for them to sell property and mortgages and get commissions and fees generated that way. So just be really mindful of that type of strategy. Now, when it comes to shares or managed funds, I find they're typically well suited for regular savings or investment plans. And so a lot of our younger clients are quite keen to actually start investing, even if that's only a couple of $100 per month, for example, because they understand the power of compounding, which means that the sooner you start and the more you invest, obviously, the better your long-term results will be, because they rely on that compounding to do the heavy lifting for them. And compounding basically means obviously that your investment grows in value and then compounds from there and generates further investment returns. So imagine if you started investing at age 30 as opposed to age 50, potentially in that extra 20 years that you were investing, your money could have doubled twice within that time, which obviously means that you need to invest smaller amounts than if you were age 50, for example, because then you don't have the benefit of time and making that investment work for you. So compounding for doctors and dentists is incredibly important. And so we see a lot of our clients start to invest as soon as possible. The other principles that I swear by when making investment decisions for myself and for my clients is that you buy quality assets. Don't buy speculative investments and put your life savings into that. Sure, if you want to have a play, for example, with a little bit of your money, that might be fine. But we want to make sure that the life savings or the retirement funds that we're managing for our clients are diligently invested and are invested in traditional asset classes and good quality investments. Buy and hold sort of fits into that strategy as well, because obviously if you buy good investments to start off with, there's probably very little reasons as to why you would change them and start trading actively. There's some more sort of principles, I guess, that we stick by, which is diversification, as we mentioned before. The clients that I've seen do really well financially were doing a number of different strategies. They invested in superannuation, they had some savings, they had perhaps a property investment, they were diligent with their cash as well. And so they spread their investments across a range of different assets, which obviously lowers the risk and typically doesn't affect the return that much in a negative way. Keep your costs under control. Obviously, there's a lot of investments on the market nowadays. Some of them are really expensive. Other ones are quite cost effective. And obviously, the more you pay for an investment, potentially the less you get as a return. So just be mindful of that. And then finally, I think you need to work out for yourself whether you're a passive or active investor. Active means, like we said, obviously, perhaps trading stocks, having a stockbroker, being very interested in the market yourself and constantly looking at where the opportunities lie. Whereas a more passive investor believes that the share market will ultimately return a particular performance number if they just invest long enough and minimize costs. And obviously that's a lot less stressful and a lot less involved. So you need to work out for yourself what type of investor you really are. Now, for the final part of this presentation, I wanted to look at a few ownership options in terms of where you could invest in shares or managed funds, for example, because obviously we need to make sure that we're minimizing your tax as much as possible. Now, trusts are a great vehicle, and many of my clients have family trusts or are looking to implement family trusts for their investments. So basically, a trust has numerous benefits in that it offers asset protection and obviously offers many tax planning opportunities as well. Now, typically, they're obviously more beneficial where you have beneficiaries that are adults, which could be elderly relatives, for example, or obviously adult children, because trusts do not offer tax-effective distribution options to minor children. Now, trusts are very flexible in that you can invest in pretty much whatever you like. It could be term deposits, it could be shares, managed funds, property syndicates, basically whatever you name, you could pretty much invest in. And like we said, they're very tax effective, and they obviously can also have a function within your private practice structure where they act as a stream-through vehicle to allocate profits to the most tax efficient entity. And so for a lot of our clients, like I said, we have started investment portfolios within family trusts because they're at the right stage of life. They have sufficient surplus income and they obviously want to minimize their tax going forward. Now, an alternative to family trusts are investment bonds. They're probably lesser known, but they can be quite useful in that they offer a 30% flat tax rate. So, for example, if you want to start investing but you have no beneficiaries that you can stream income to through a family trust, then an investment bond might be a good vehicle. And so a lot of our younger clients have started this type of portfolio. So typically you need a 10-year time frame, because once you've held a bond for 10 years, it matures if you meet all the other conditions. And then from that point onwards, any money that you take out of the bond by way of a lump sum or an ongoing income stream will not incur any further tax. So in that respect, they're a bit set and forget, like your traditional retail super fund, for example, where you just contribute a regular amount, typically via direct debit on a monthly basis. The money gets invested, it's taxed internally, so you don't have to declare it in your tax return. And then at the end of the day, in 10 years' time, once you've had the benefit of compounding, you can decide to start cashing in some of that money, or you can obviously let it grow and continue to invest further. It's very popular for school fees as well, and they come in a different form, being called education bonds. And there's some additional tax benefits within those as well. A lot of our clients set up education bonds for their children as well, because they like the idea of having a separate investment portfolio working very tax effectively for their children. Finally, just wanted to have a quick word about superannuation, because it's obviously still a very tax-effective environment for both doctors and dentists. Hence why a lot of our clients, again, maximize their contributions even at a young age. And so many of our clients actually contribute $25,000 per annum, because, again, they believe in that long-term compounding benefit. And it's obviously, again, very tax effective to do so, because it gives you an instant tax deduction. Now, some of the major mistakes that we see when it comes to superannuation is that a lot of people run different funds. And so, give you a few examples. We've saved a couple of clients over $8,000 per annum because they had probably 5 or 6 super funds between them. So $8,000 in annual fees. And on top of that, they were duplicating insurance covers, which was another $2,500 per annum as well. So imagine saving over $10,000 per annum just on your super, and how much more money that would mean after 20 years. It's obviously an enormous amount. The other thing, again, to be mindful of is to minimize your fees, because obviously, again, those eat into your return. And really, there's no excuse nowadays to have a very expensive super fund, because there's so many options available. When it comes to investment, some of the major mistakes we see is that people either invest too aggressively for their age or too conservatively. So let's say you have a 30-year-old who's 100% invested in cash. That's obviously typically not suitable for the long term, unless you had some plans, I guess, to invest that money into something else. Make sure, again, that you diversify where possible, rather than, for example, putting all of your money in Woodside shares, so to speak, or just in Australian shares, because obviously that happens a lot as well, particularly with self-managed super funds. Insurance we've talked about, so just be mindful that insurance premiums, yes, obviously you can pay them through your super, but they will eat into your super balance and your retirement benefits over time, and that can be quite significant. Super splitting is something we do quite a lot for our clients, because typically we have one spouse who works and earns a significant amount, whereas the other spouse typically stays at home and looks after the children. So we want to make sure that the spouse that is not working is receiving super benefits as well, and so we'll often set up a super splitting strategy so that the super benefits are equally shared between the two spouses. Self-managed super funds, look, personally I think they're a bit overused. I'm not a huge fan of them. I think they serve a purpose, particularly where, as a doctor or a dentist, for example, you want to buy your own rooms and invest in commercial property. So that could be a useful strategy. But for any other type of investment, really, that can be replicated with other with other super funds or super fund options that are probably more effective and time and cost efficient as well. So just be mindful that obviously self-managed super funds come with a lot of obligations, and it may not be the right option for you, even though a lot of your colleagues and your peers might be setting them up. So look, that brings us to the end of this webinar. I hope you enjoyed it. I could talk for days about each and every single one of these topics, but hopefully this has given you a good starting point. I do have a range of free ebooks and books on my website, so please have a look and contact me if you'd like me to post out a copy of my book. The ebooks you can just download, obviously, straight off the website. Now, if you want to take some action, obviously there's two ways you can do that. You can educate yourself and try and implement some of the things that we've talked about today. Or you can book a free 1-hour strategy session with myself. So I'm offering 10 of those sessions every month for prospective clients. And it gives us an opportunity to discuss your current position and your goals and highlight what you should be focusing on. So it's not advice, obviously, but it's sort of like a financial health check in a way, which will allow you to then to plan in terms of what you should be focusing on for your finances. So once again, thank you for listening. Feel free to reach out, provide any feedback that you may have or any ideas for future webinars. Look, I hope to see you again in the next webinar. Thank you. Bye.